Uh, Good afternoon. We can start from where we have stopped last week, and we broadly discussed about the advanced economy experience in terms of financial crisis last week, and we can finish off the financial crisis discussion today by discussing the financial crisis experience of emerging market economies. When I say emerging market economies, you probably see some of the countries who have substantively improved their financial market access, and also in terms of growth in recent period, but the period what we are referring here is prior to 2010, and there were countries who had a substantively high degree of elevation in terms of their income, in terms of how the experiences in the financial markets and other broader macroeconomic details. And this is what you probably discussed in terms of BRICS countries. And during that period, Brazil, Russia, India, China, right? And then some also include South Korea, and also smaller countries, but significantly influential financial markets like in the Middle East, the UAE, and then of course you see countries like Hong Kong, Singapore, and they're all there. And Singapore, to some extent, in terms of their income and other things, they also fall into OECD consideration, right? So when I say this type of kind of a classification, emerging market economies, like these are very much reached closer to higher middle income status. They have gone to higher side of the middle income status of World Bank classification. But then the experience in these countries also reasonably significant, simply because they directly felt the heat of the epicenter, that is US, and then subsequently the advanced economies in Europe. And these countries also felt the rapid deterioration in terms of their asset prices, and then of course the balance sheets of financial intermediaries, and also to great extent simply because their exposure and link with the advanced economies, financial flows, inflows and outflows, right? So you can kind of get a kind of a feel about these countries from that type of explanation. But interestingly, they also had different stages in terms of the financial crisis. And then the first stage, the path one, like what invariably reflected is some mismanagement in those economies in terms of financial openness. To great extent, the liberalization and globalization measures have been kind of given free access in most of these countries without having much of a check and balance arrangements. And this is to some extent their desire to benefit from the global financial flows, and also the benefit from expanding global know-how with the globalization. So they opened up their economies without taking adequate measures to strengthen their financial supervision, and also to some extent the expertise had with them in terms of overall financial supervision in these countries. And also they experienced some lending boom partly driven by their own policies, and also from the perspective of advanced economies, financial intermediaries coming and opening ventures in these economies, and then facilitating a financial facilitation. That means lending to local enterprises, lending to local institutions, if not lending to foreign direct investments in those economies. I mean, to some extent, those institutions who are bringing in foreign investments to these economies are originated from those advanced economies like US, China. I mean, you see the Chinese experience to some extent and East Asian experience to some extent. If you look at real base of some of those initial investments are mainly from advanced economies. And Japan has invested a lot in East Asia, in many countries. Most of the FDIs that you are seeing and exports that you are seeing from those countries now are effectively companies whose base is Japanese, right? So likewise, what you are simply seeing here is that the initial stage of financial crisis, most of these emerging economies opened up their economic frontiers without kind of building their financial regulatory supervision expertise, and also they experienced some lending boom in the circumstance. And also they have opened up their banks to financial intermediaries to go abroad and borrow. Okay, so they have linked up with their counterparts in rest of the world, mainly from advanced economies, and also they have started arranging direct finance from most of these advanced economies. And also from another perspective, the branches of foreign banks operated in these economies had easy access to foreign finances from their parent banks or their counterparts in the rest of the world. Okay, and also the exchange rate in most of these emerging market economies to some extent fixed, right? So when the exchange rate is fixed, that takes care of, if not take out, the so-called the risk in financial markets, because you see exchange volatility being taken out of the equation. So when the exchange rate is floating with the market circumstances, exchange rate depreciate, appreciate. But when you have a fixed arrangement, it is either revaluation or devaluation. Devaluation is depreciating, that means you are lowering the value, and revaluation is you are increasing the value, that means your currency has strengthened. That's a exchange rate arrangement versus floating exchange rate kind of jargon that we are talking here. But what you are simply seeing is some of these countries had relatively stable, if not fixed, exchange rate environments. So that has taken out so-called market risk in the form of volatilities in exchange rate. So they had some sense of risk taken out by the exchange rate arrangement in some of these countries. Okay, and also in these economies, indirect finance, even though you know already, even in advanced economies, the indirect finance is the dominant force. And in these emerging market economies, role of indirect finance is much more stronger. Financial intermediaries are the ones who mainly fund all these SMEs and other agencies in these economies. Okay, and then of course you are also seeing their securities markets. That means direct finance arrangements are not necessarily that developed. Sometimes they had experiences where you see they don't have a clear price determination or price discovery process, supply and demand forces interacting, and clear trading platforms to have financial assets being priced based on market supply and demand arrangement. So they had some elements of these features at the initial stages of financial liberalization in these emerging market economies, right? We can move on like different stages and elaborate on that basis. And as I was always mentioning, you can raise any clarification that you require. If not, you can kind of put your questions that you wanted to clarify through the chat mode here, so we can follow up as we move on. So you see these elements in these emerging market economies, and also from another perspective, these countries experience fiscal imbalances. That means the possibility that they can spend in terms of fiscal measures is substantively limited, if not non-existent. These countries had budget deficits, and these budget deficits were prolonged, right? So the governments in these economies in need of funds, okay, and also to some extent in these economies, the banks who had some excess resources been pushed towards purchasing government debt. So they cannot kind of go and lend to the private sector. So this is what we in economists openly discuss about crowding out resources for private sector. So the government borrowing crowd out resources available for private sector to finance their operations, right? So in these economies, when they had fiscal space being substantively limited and reduced, they tend to kind of, also make arrangements with their financial intermediaries to purchase government debt on a continuous basis. And when the government debt loses value, and banks also lose because they are the main purchasers, subscribers of government debt, and subsequently the net worth of those financial intermediaries and whoever held these government debt also loses. Decreasing net worth, correspondingly contribute to a lot of distress in the financial market, and also reduces the demand by the people who had higher net worth previously. So what you are basically seeing here is when the interest rates volatility is experienced in these economies, and particularly when they see interest rates are increasing, when the government requires to borrow more funds, when their fiscal space is not sufficient, okay, it's a deficit financing. So when they wanted to increase further borrowings, what happened is naturally the government increases the supply of bonds. So when the bond curve shift out, what you can basically understand is the prices reduce. Prices reduce means interest rate increase. We were discussing all these things many times in our previous lectures. So when the interest rate increase, all interest-based assets held in banks or any organization's portfolio loses value, right? So when the interest rate increases, price decreases, so the assets held in their portfolio loses value. That means their net worth also decreases, okay? In addition to this, these countries also had to increase their interest rates, okay, where invariably to kind of protect to some extent the exchange rate, okay. So also from another perspective, if they had access to foreign finances, right, so when they opened up, they have opened up their financial intermediaries to finance from foreign countries. So when they see that the circumstances in domestic economy itself, the interest rates are increasing, and in the international markets, the interest rates are increasing. We were talked about those spreads increases in advanced economies itself. So when you see such increases, they are also forced to some extent accept higher interest rates from foreign markets. So when the foreign interest rates also increases, their borrowing cost naturally increases. So the resulting impact is asset prices decreases in these economies. And then the uncertainties linked to unstable political circumstances in these emerging market economies. Very open examples in Southern Europe. I mean, you probably seen all Southern European countries had the governments been change every other month, like during the peak time of the crisis. Italy, Greece, Spain, all these countries had these experiences, right? And even countries like Japan, although it's the same party who are in power, they also had difficulties of having a stable government running for a longer duration. The prime ministers were, all the time you see a new prime minister, new face is occupying the seat. So there were a lot of uncertainties linked in terms of political system in these countries with the challenges exposed through economic fallout. So that is a very, very important element that further increased the uncertainty across these emerging market economies. And then you see the second stage in these countries is the currency crisis. So they are already experienced, their domestic interest rates are increasing, their deficits have gone up, and they were previously maintaining a reasonably stable exchange rate, like that's forcefully managing the exchange rate. So then what they have seen is the bank balance sheet, as we were talking all throughout, with the net worth losing, the bank balance sheets also deteriorate, and as a result, that trigger currency crisis, right? So when you see the bank balance sheets decreases, now they wanted to raise additional capital from the rest of the market. The interest rates have gone up, and also the sources of foreign flows have now become costlier. So naturally, the balance sheets impact kind of a push these economies to see their currencies also weaken. That means realign the currencies in line with other macroeconomic fundamentals. So still, I mean, you cannot expect kind of the market determined exchange rate in some of these markets. So they also had kind of a managed float. So they had tried to kind of maintain exchange rate at levels, but no, the reserves were not sufficient, foreign inflows were not coming, so they had to let go, and let go means currency started weakening. So the government now exposed to circumstances where they cannot further raise their interest rates. Okay, so when they start further increasing, that pushes the banks or the governments to see their assets are declining further in prices. So what then happened is further net worth losses. So banks falls into so-called insolvency, right? So governments also kind of are forced into a situation where the interest costs are actually increasing beyond the levels that they can maintain in there, right? So then the speculators come into play. Speculators expect a devaluation. So I was mentioning, under a fixed exchange rate arrangement, weakening of currency by administrative action is devaluation, right? So revaluation is increasing the currency under a fixed exchange rate arrangement. So the devaluation expectation build in the economy. So even the people who can have assets maintained in domestic currency now demand foreign currencies to hold, and even the foreign currency receipts of some of the local industries would be kept without exchanging, probably expecting a devaluation, and this pushes currency to weaken faster. So it's like inflation expectation. So if you expect inflations to come, so everybody would act that tomorrow's prices are costlier, so they try to buy today, right? So when they try to buy today, that creates an additional demand. So additional demand pushes the price up. So expected inflation that's in the future is now at your doorstep because everybody started demanding. So similarly, when the currency speculation comes in, so everybody expects your domestic currency to weaken and hold assets in foreign currency, and even the foreign currency receipts are not being converted to domestic currency and kept in foreign currency itself, not even bringing to your economy. More sometimes they kept in outside, I mean foreign accounts, right? Not bringing until the local currency get devalued. So it's naturally push your currency to get weakened. So this is another stage in terms of the balance sheet crisis that the banks and other industries faced across emerging market economies. Okay, so then severe fiscal imbalances also triggers foreign currency shortages, and then the currency crisis. Okay, so what happened here is the fiscal side is already in deficit. You need now deficit financing, but foreign currency inflows to your economy is already vacant, but you require your foreign liabilities being serviced by foreign currency inflows, right? So you try to kind of, manage, but it's very difficult, and you have already devalued. So when you devalued, you see you are expecting foreigners, if not the locals, to convert, but that devaluation is not in line with the expectation of the markets, and also to some extent the recovery in the economy is not in sight. That means that is not being seen by the market participants. They expect further devaluation, and this pushes the fiscal aspects to be get worsened, and as a result the currency crisis get magnified, right? So then of course what you see is all foreign and domestic investors try to find every assets in foreign currency and sell domestic currency assets. They try to hold assets in foreign currency. If not, even if they have options to keep in domestic currency, they probably try to kind of, you know, convert them into foreign currencies and hold, because they expect future exchange rate would give them additional benefits in holding in foreign currency. So this is a kind of a situation most of the countries in emerging market economies and developing world face, especially during the financial crisis, partly because the inflows have dried out, and from the another perspective, all the assets foreigners invested in these economies started kind of leaving out their economies. They were pulling out from those economies, and there were substantive shortages in foreign currency resources, and this has created kind of a circumstances their currencies to weaken. Okay, so then you see in emerging market economies the crisis is fully felt, and this is a fully fledged currency crisis stage now you are experiencing. So what you are simply seeing is your debt burden in terms of domestic currency is now magnified. Okay, because your exchange rate has weakened, but your liabilities in foreign currencies are not different. It's the same $1 billion liabilities you had is same $1 billion liabilities now. But in domestic currency, previously you had, let's assume exchange rate is 150 at 1 billion, it's 150 billion rupees, let's assume. So now the exchange rate is 185. So the 1 billion liability in rupees is now 185 billion. 35 billion difference is due to currency weakening, right? So what this imposes, right? What is this exposes you indirectly is your balance sheets to look smaller. That means your net worth has become substantively deteriorated. So you are not in a position to kind of have your general demand for financial assets or other related activities, because your liabilities in foreign currency is now look very big in your balance sheet. Okay, so this from another perspective increases the expected and actual inflation, right? So because now you see your economy is experiencing high interest rates, economy is experiencing depreciated currency. So if your economy is already having import-driven inflationary circumstances, your inflation also expected to increase. As a result, you don't necessarily see your normal cash flow that you are receiving to the firm is also deteriorating, because people demand less now, right? Because they don't have income. They don't have a usual income sources that they engage. And at the same time, because of the prices have increased, people they used to consume 5 units of whatever product is now using only 2 units or 3 units of that same good or service. So see, this contributes to cash flow deterioration. Okay, so then this exposes the financial intermediaries. Financial intermediaries in now kind of circumstances, exposing to a circumstance where they are like more likely to have a very tighter balance sheet circumstance. Okay, and the people who borrowed from financial intermediaries are also facing difficulties in settling their liabilities. So they might not honor. And what happened here is, if it is become really challenging, they will hand over the collaterals that they have kept for financing facilities. So the collaterals also now lost in value. This experience is not different to advanced or emerging market economies. Everywhere, when you see interest rates, exchange rates all deteriorate, you have difficulties in terms of losing value of your collaterals. Okay, and then as I was explaining previously, if you have already liabilities in foreign currency, they are not denominated in foreign currency, that's value in domestic currencies now look magnified. So you need more domestic assets to service the same amount of foreign liabilities. So your balance sheets further weakened in such circumstances, and this was very common across right. So you can figure it out, this type of circumstances across all economies in this financial crisis circumstance. And these features that we have now seen in the fully fledged stage, whether it's emerging market or advanced economy, it's reasonably same. We don't necessarily see much of a difference, but advanced economies had the benefit where their currencies have not necessarily weakened much, and in fact at times US dollar still appreciated, interest rate decreased in US experience, and in other the advanced economies also their interest rates have substantially reduced because they had spaces in their budget, and also other rest of the world is demanding some assets from those economies, and other thing is the funds which were invested in emerging and developing economies also started pull out and go back to their bases, like mother companies in those advanced economies. So that also created demand for their risk-free government securities assets in most cases. That's why US Treasuries almost hit flow level of interest rate, closer to zero level of interest rates during financial crisis. And even now you are seeing it is closer to zero level of interest rate. So you see this type of development in emerging market economies. And then the sequence in this emerging market experience is also no different in great extent to advanced economies experience. But at stage one, you probably see the balance sheet deterioration, increase in interest rates, asset prices declining, and uncertainty in the emerging market economies. And this contributed to so-called adverse selection and moral hazard problems and worsening lending contracts, right? So what you are basically seeing is a circumstance kind of a push these economies to a situation where the good borrowers are running out because they simply see they cannot borrow at those rates. So whoever try to borrow from financial intermediaries at these circumstances are the ones who are risky. So the chances that adverse selection get magnified is very high. So then, of course, the moral hazard issue comes in, so-called principal agent problems and things. So even the people who borrow would not necessarily reveal all their expectations. They probably take more risks than what is permitted. Okay, so then the banks also aware of these possibilities tighten the conditions of the lending contracts. Okay, already interest rates have been increased, but at the same time they probably want more haircuts for collaterals. When they wanted to lend 1 billion, they probably wanted 1.5 billion assets being pledged, right? Or at least somebody is giving guarantees like governments. Right, so this worsened the lending contracts in such circumstances. And then you see at stage 2, the foreign exchange crisis comes into these countries. Their assets being foreign currency liabilities being now magnified in domestic currency simply because of the weakening of the currency, and also the foreign assets being kind of pulling out from these economies, and then further problems in terms of the maintaining exchange rate. So the devaluation and things, then again you fall into the same trap of adverse selection and moral hazard problems, and then lending contracts. So as a result, when you experience the fully fledged financial crisis circumstance, your economy is not growing. So you are experiencing your economy is falling down. So when you see your economy is falling down, so your growth is weakening. So when your growth is weakening, so your possibility that you are coming out from the troubles that your economy is experiencing is also get delayed. And as a result, the balance sheets of banks or financial intermediaries that we are discussing here cannot kind of, revert back to its normal positions that fast. It will take longer than they expected. So this would further worsen the circumstances these banking institutions experiencing, and that pushed them to maintain tighter lending contracts. So tighter lending contracts mean they also are not happy to extend financial facilitations to most of these industries in these economies. So that would further reduce the economic activities in these markets. So this, the circumstance that most of the countries experience all throughout in these economies. So the emerging market economies had this, and then there are few other experiences in countries like Mexico, then East Asia, so-called Asian tigers during those periods, and Argentina. Argentina, of course, had repetition of some of these problems in 2013, 14 also. And you see some elements of financial crisis experiences in these emerging and developing economies prior to the 2008 financial crisis, global financial crisis was noted. So you see these experiences of Mexico and then East Asia and Argentina. So I would not try to kind of detail them here. You can just have a glance and kind of get a kind of a feel about how they must have felt during these periods in their economies, right? So with that, we will conclude our financial crisis discussion. So you have the experience of both advanced economies and emerging market economies. So that would give you a greater depth in terms of why these economies felt these difficulties in terms of different stages that we discussed. So you can now compare these things with the COVID-19 environment related possibilities, but it is not necessarily a financial crisis as such. It is more or less humanitarian, if not health driven, and as a result, economic crisis across the globe. So global growth has been substantively come down. So you can visit International Monetary Fund, IMF's World Economic Outlook Report, WEO, W-E-O, World Economic Outlook. So the recent World Economic Outlook expects the global growth to shrink. That means decline by more than 5% in 2020. Okay, so the global growth to decline more than 5%, and you can figure it out different reasons on what basis these economies are experiencing such decline in their economic activity. So I will not try to detail them at this stage. You will be able to kind of have a look at the IMF's World Economic Outlook report and get a kind of a glance on the recent projections and possible downturn in global economy driven by the COVID. But it's not a financial crisis, but it's more or less economic crisis. So economic crisis has spillovers into the financial sector, where the non-performing loans, losing collateral values, adverse selection moral hazards, all there. So you can kind of experience some similarities across these circumstances in these economies too. So with that note, I'll just keep out from the financial crisis discussion. Any questions before we move into another very important area of discussion, that is economic analysis of financial regulation. Economic analysis of financial regulation. So this handout also, I understand that's been distributed and that's available with you all. Right. If there are no questions for the time being, we can move on to the financial. I think they have loaded a wrong presentation. Right. I had to cross-check with them. I believe you have the right presentation shared with you all. Okay. So give me a minute. I'll cross-check with the IBSL because of this mishap in terms of the presentation that they have loaded in the website is not the one that I intend to do with you all today. This, I think, we have already discussed. We have already discussed this lecture. Yes. Right. Yes. Right. So you see, now you have the presentation. What I have asked them to upload, now it's available. So there's also a question that one of you all have posted. So it's basically asking possible questions on financial crisis. What would be the best action to counteract and stabilize in the economy? And of course, there are two aspects to stabilize the economy. One experience during financial crisis and now with the COVID environment. One is counter-cyclical policies. Counter-cyclical policies are the ones which are fiscal policies, monetary policies, and also other related policies which are aimed at boosting the economic activities, right? So when the private sector is not investing, government is investing, right? So when the markets are one-sided, right? So the government or its affiliated agencies create a market, right? And to some extent, kind of it's a Keynesian economics experiment where government expand its expenditure flows, right? But unfortunately, for a counter-cyclical policy environment, especially counter-cyclical fiscal policy environment, right? The government budget should have spaces. So if you are a country whose budget deficits are not necessarily prolonged, and you can adjust a bit on your budget deficits at times of difficulty, crisis, that's fair enough. You can introduce some measures during that period where you can reduce the taxes, right? You can increase the government spending, and you can basically create a demand in the economy. Government can play a role there. So through which government could kind of balance the difficulties by injecting resources to the economy in such circumstances. But unfortunately, many of the developing countries, including Sri Lanka, do not have any fiscal space. We are already up to our nose in terms of the water level. So we are basically drowning. So we can't breathe. We are come to that level in fiscal aspects. We are continuously having fiscal deficits, right? So then what about monetary policy? Monetary policy if your inflation are well anchored, inflation are reasonably at low levels, right? You don't necessarily see inflation, right? Demand is also plummeting, not much of a big demand. People are now not buying goods and services, and they are kind of a general living pattern because of the COVID has changed. No travel, right? No fancy restaurants, no changes to their clothing patterns, and frequency of new purchases also reduced. So then you see some space there in monetary policy to bring their interest rates down. And also monetary policy could, now as in Sri Lanka, they have done a lot of measures where the fiscal policy in Sri Lanka was basically silent, right? They don't have space, right? They have exhausted all the spaces available, right? But monetary policy, everything in Sri Lanka during COVID period is mainly monetary policy driven. They have cut the statutory reserve requirement where the banks have to park certain percentage of their deposits with the central bank. It was 5%, but now it is only 2%. 3% has been released back to the banks. So it's in absolute terms about 185 billion rupees, right? So when you see such an injection of new liquidity, the resources are now available for banks to enhance some lending activities. Their cost of financing also has come down because previously for each 100 rupees of deposits, only 95 rupees were working for them because they have kept 5 rupees with the central bank. Now they have to keep only 2 rupees for every 100 rupees of deposits. So 98 rupees are working for them, right? So they can reduce the cost that they are lending to the financial market and other related activities. And then from another side, central bank has brought down the interest rates. The deposit rate, overnight deposit rate, overnight lending rate has been brought down by more than 200 basis points, right? So you see that also reduced the interest rate. So the monetary policy is giving all injections and stimulus to the economy to function, right? Because Sri Lanka's inflation expectations were well anchored. We don't necessarily see big inflation in Sri Lanka. Yes, people might see the prices are increasing, but then it is well within like 4 to 5% across last 12 years or so. It's never gone above 10%, right? So look at those numbers. Of course, one would argue the CCPI and NCPI does not reflect the actual. Okay, fine. For some it might not reflect, but averagely it reflects, right? So central bank has done many things during this period. Of course, there were sometimes the delay in lending to certain sectors were questioned, but it's not because central bank do not just go and lend. I mean, they look at things because they don't want to see that the banks are making use of central bank's window and cushion to kind of, expand their moral hazard behavior, right? So they would extend guarantees, they would lend to the troubled sectors with a kind of, dedication and commitment from the bank also at a very low interest rates. Central bank lend to banks in Sri Lanka now under those schemes at 1%, and they lend it to the final clients at 4%. Okay, and at times they extend 80% guarantee for those lendings. So only 20% funds that the banks have to extend it to those agencies. So these are the measures that you can bring in, but then you have to mindful whether Sri Lanka's circumstance, right, is right in the sense the inflation expectation and exchange rate. Of course, from the exchange rate side, we have difficulties, right? So we see we don't have big reserves to kind of, spend on this basis. So we are mindful. That's why there are other measures also introduced by the central bank initially to reduce unnecessary imports to the country. And then the government also acted upon it to introduce the capital outflows being limited to great extent, but still you can import intermediary and capital goods to the country. Intermediary goods are the ones that we used as raw material for final production of final goods and services for exports mainly. So there were a lot of changes, and also we had some cushions in recent times where the oil prices have come down. So otherwise we had to import oil, not only for transportation and other related purposes, but also for power generation. Only hydro gives only about 1/4 of power generation in this country. More than half being generated through furnace oil, or coal about 1/4 again. Okay, so those prices have reduced in international market. So that's a cushion that Sri Lanka and most of the developing countries experiencing now. So then the Sri Lanka would like to kind of see some facilitation in terms of their liabilities being official liabilities, credits and things like that being offset to some extent. These are all possible, but under negotiations, discussion. Okay, and of course there were countries in Europe also. Yesterday, day before yesterday, they have signed a 750 billion euro expenditure package for European Union. And Germany, France, the major two economies in the European zone, they have inked that with other European countries to facilitate some boost to the economies in such circumstances. So expenditure spaces, they have that space because they have reasonably reasonable budget outlook, not across all the countries, but some European economies have reasonable space. But the European Parliament, European Central Bank is facilitating that in Europe. And in US, it is a 2 trillion stimulus package. Okay, people who are lost their jobs, they don't have income. So they've been paid about $1,200 per month and other facilities. But then, of course, there are other elements also coming to play in those economies. But in Sri Lanka, we also had 5,000 rupees being distributed for a household. Okay, so there are arguments, okay, why not another 5,000? But we need resources. Budget does not have space. They have spent all, and they have partied too much, I believe. But it seems that they don't have space, but monetary policy has contributed a lot of space in such circumstances. But government also chipped in with many measures to curtail unnecessary expenditure in the form of imports and things like that in recent time, to kind of give a little bit of a cushion from these difficulties. But yes, we don't necessarily see much of a growth push. It's very difficult because people are not necessarily seeing that much of economic activities carried out given the COVID circumstances. Okay, so these are like circumstances that we are exposed, and the countries all across the world now exposed. But the simple kind of a circumstances of financial crisis is slightly different to this, because it is mainly financial market driven. This crisis now we are experiencing is not necessarily financial market alone. It is overall economic circumstances driven by health crisis. So you can't travel. Tourism has collapsed, right? So you can't have usual economic activities without having restrictions, distancing, all kind of things. Okay, so this become new normal to some extent across the globe now. So that's why IMF, I was asking you all to read, so that will give you some explanation and give you some a picture about how the world is looking at these things at the moment. But it is very interesting, right? So financial crisis, where you have seen different stages of problems, and then how best the world is coming out from those through many stimulus and environments through that they have created both counter-cyclical policies, both fiscal and monetary policies, as we now discussed. And also they have introduced a lot of kind of regulatory and supervision related changes to avoid the banks doing ad hoc lending, loose credit evaluation. They don't necessarily look at the so-called financial liberalization with check and balances. Those being brought in with many prudential measures, macro-prudential measures, right? Micro versus macro-prudential regulation we will be discussing as we move on, most likely in today's lecture that we are now starting and going forward. So I hope this kind of cleared some elements of discussion, right? So we might happy to see Sri Lanka also receiving some facilitation from IMF, World Bank, budgetary support kind of arrangements, because that would help foreign currency resources flowing into Sri Lanka to some extent. And we have taken measures, central bank has taken measures to have a $400 million SOP facility with the Reserve Bank of India. We signed it yesterday. Reserve Bank of India signed it yesterday. We have signed it about 2 weeks ago. And similarly, we also keeping options open for a SOP, if not a repo facility, repurchase facility with the Fed Reserve Bank of New York. That's the US Central Bank's New York branch, right? So it's a liquidity facility. So when you wanted to have quick foreign currency requirements, you can get into that and get that. So these were the facilities that they are looking at. So I hope this answered some of the concerns that you all have raised. So we can move on to the economic analysis of financial regulation discussion. Any further questions, please feel free to send me a message so we can follow up on that basis. Right. So as we were discussing so far in this program, and also discussed in our previous lectures, the financial system, or financial intermediation from another perspective, you can call it is one of the sectors which is heavily regulated in any economy. The financial system is one of the sectors that you come across has so-called regulation. So it's not right to say heavily regulated, but among economic sectors, financial sector gets a lot of attention in terms of regulation. Okay, within the financial sector, so-called banks or the financial intermediaries who accept deposits. Deposits are not necessarily their own resources, but resources of general public, right? They comes under the financial supervisors or regulators perspective. Okay, so this is the kind of a general perspective across the globe in terms of financial markets and the financial intermediaries. So in this section that we are now trying to discuss, we develop an economic analysis, okay, why the regulation of banking takes the form that it now you are experiencing. Okay, but one thing you have to understand is, although there are regulation, so-called regulatory process may not always work very well. That means it does not prevent banks from kind of going to insolvency, failing banks fails, right? But it kind of contribute to avoid possibilities by introducing many measures. Otherwise, the people who are in financial intermediation would extend so-called moral hazard intentions and behavior. So what the regulation would try to do is would try to minimize those prospects. That's why you see all across the world you find banks are failing. And simply because you had regulation yesterday, today, and every day you are having both on-site and off-site regulation. On-site means you are physically visiting the premises and looking into books and systems and things and doing the regulation, supervision. Off-site is not necessarily you are visiting physically, but You have electronic transferring and other arrangement of transferring details on a continuous periodic basis. So that's been evaluated by regulators. But still, right, market risk is so much that the institutions could go bust within a matter of very few hours. Right, the exchange rates volatilities, interest rates volatilities, then the systemic problems, hackers, all kind of things possible. So regulation would bring in some element of certainty in terms of bringing orderly behavior in the banking and financial sector and in financial intermediation. Okay, so here in this discussion, we also use so-called economic analysis of banking regulation to explain the crisis in banking and how regulatory systems can be reformed to prevent similar crises and disasters repeating. But what the experience says is the financial crisis could repeat with new form, new magnitude, irrespective of the level of supervision, level of regulation that you are experiencing in current day. So because it's a dynamic process, so new financial instruments comes, new financial instruments being defined, introduced by market participants, that exposes these agencies and institutions into new risk criteria. Okay, so you see these possibilities across these financial markets, and then you see a main reason for so-called financial regulation again is the asymmetry of information. Parties to transactions do not possess equal amount of information. Asymmetry. Some has more, some has less. Even if you have similar amount of information, your capacity to understand, review, evaluate differs. So there's asymmetry. Okay. So as a result of this, the bank panics. You're panicking. You are worried that my deposits with the bank A is at risk. So you are the first one in the queue before the bank opens to pull out your deposit. So you are panicked. So similarly, everybody else in an economy. If everybody start panicking, so everybody queue up. So this is what you are seeing in this picture. So-called war of wealth. The run on the bank. So when the banks are on a kind of difficulty, everybody thinks that this bank would not be able to honor my deposits. So you are trying to be the first in the line to pull out the deposit. So the bank also would be in a difficulty because they don't have liquid assets to pay to all the people. They generally keep about 10% or 12% of, depends on market conditions, right, of their assets in liquid form. Okay, so this compel the banks, because of these bank panics, bank runs, to introduce a so-called deposit insurance. And you probably hear in Sri Lanka these days, the finance companies, some of them are facilitated through a deposit insurance arrangements, but up to a certain limit, not beyond that, right? So so-called FDIC, Federal Deposit Insurance Corporation in US was one of the first and primary sources of deposit insurance and introduced to take out the possibilities of bank runs or bank panics. But that does not mean that bank panics would not repeat. Still with the FDIC, there are bank collapses, bank failures. But to some extent, some confidence among depositors that the deposit insurance will look after my deposit would prevent banks from force selling their assets to meet the obligations, and thereby not getting the price that their assets that could actually fetch from the financial markets. What you are seeing here is so-called FDIC, Federal Deposit Insurance Corporation kind of arrangement that short circuits bank failures and contagion. Okay, when you have a electric shortage, right, you basically short circuit it, then you probably prevent that electric shortage or that difficulty spreading out to the other buildings or the other parts of your house. So the same is applicable with the federal deposit insurance. Okay, so what this FDIC kind of arrangement is, it's a safety net, either by government. In the case of FDIC, federal itself, it's a government, it's the federal government, US. Okay, but it could be a private driven, that's possible. A government safety net for depositors that can short circuit runs on banks and bank panics, and by providing protection for the depositor, it can overcome reluctance to put funds in the banking sector. So what it basically tries to do is to short circuit so-called panics and bank runs, bank failures, and gives a kind of a protection to the depositors that your money is safe, even if the bank has made some wrong decisions, and as a result the bank is losing their revenue and not in good shape, still your deposit is reasonably safe, and that build confidence among general public and market participants that they can rely upon financial intermediation. Otherwise, nobody will come to financial intermediation if everybody thinks that the banks are not safe, right? So there are various ways when you see a bank run shapes up, the banks start paying off their liabilities. Deposits are liabilities. Okay, it's not bank's money, it's the depositors' money. So it's a liability in their balance sheets. So they use a payoff methods, different payoff method. First come, first serve. That's a very simple way of paying off. So you are in the queue, you get first to walk in, so you get paid, right? If not, there are other various ways of payoff arrangements by these agencies, right? Financial intermediaries. And that's been defined in terms of the level of acceptance in the liability order. Like common shareholders get last piece to be distributed among them in a cake. First, the cake being distributed among others, like loans, preferential shareholders, those are liabilities first. And ultimately, what is left with the is distributed among. It's like sometimes in functions, the people at home eat last after seeing everybody else have consumed whatever. Okay, sometimes they get more, sometimes they get less, right? It depends on the circumstances. So it's similarly, I mean, you see payoff methods also works. And also there are methods called purchase and assumption method. Okay, so this is not necessarily a payoff, but what happened here is when the bank panics and things sets in, kind of reorganizes the banking arrangement through purchase and assumption. So when the bank A tries to fail, the regulators bring in bank B and C to take over the bank A. Okay, so bank A now get a kind of a support from B and C, and B and C would do that for a kind of a fee structure and kind of a bring in some regulation where they might introduce the deposit withdrawals being limited to very small values. If not, for a duration like 1 year or 2 years, the deposits cannot be withdrawn. Okay, but this sometimes gets really costly because government bring that into their shoulder and take the responsibility to settle all the liabilities of these agencies. So that is more costlier than a deposit insurance arrangement. So deposit insurance arrangements are now becoming much more fashionable in financial markets in terms of preventing bank panics and bank runs. Okay, so then you see other forms of safety nets. So if you put a safety nets below, anything falls from the roof would not fall to the ground. it falls to the net and somebody can kind of, prevent it from breaking, right? Even next to high rises, apartments and things like that, you see some nets being introduced. Okay, so you park vehicles, above that you see different type of screens. Probably you introduce a net, so you don't fall to the ground or break the vehicle underneath it, because of this protection that you have given. Okay, so this is in a way these safety nets introduced by governments, okay, prevents these agencies from collapsing. For instance, lending from central bank to troubled institutions. So the central banks have so-called lender of last resort facility. So when everybody else in the market is not lending any longer, they are not sure of this agency, they can't trust this agency's management and also the assets that they have for collateral. So central bank has to come and kind of, extend some facilitation as the lender of last resort arrangement. So these were the kind of, safety nets that you are looking at. But all these arrangements are to prevent banks from failing, banks from collapsing. Any questions? Right. So you see these possibilities, and then of course so-called safety nets, while it's been there, this create the so-called problems, moral hazard. So when you see the safety nets is there, sometimes it's not only that you are aware of that, yes, if anything happens, there's something is there. So you overdo and tries to kind of, see that you are taking additional risks. You're not necessarily protective enough. And you see your godfathers are there, like central banks as a lender of last resort, right? So then you see you are not necessarily managing your assets and liabilities. So this is a problem. So that's why when you see safety nets being introduced, there's some form of cost also involved. So it's like insurance. That's why they call it FDIC, Federal Deposit Insurance Corporation. So for deposit insurance, you have to pay something. So that's to make you feel that there's a cost. There is nothing called free lunch in this world. So you see these safety nets from another perspective creates moral hazards. So what is moral hazards? You know that. Okay. So moral hazard behavior becomes so common when one person takes more risks because someone else bears that burden of those risks. So he knows somebody else would take it, right? So because of that reason, you are not careful enough. A moral hazard may occur where the actions of one party may change to the detriment of another after a financial transaction has taken place, because banks might expect you as the borrower to spend this money as you have already defined and explained in the agreement. But you may go beyond that simply because it's not your money, it's the bank's, and you are not necessarily the owner of the bank also. We will come to that. That's the principal agent problem, right? So when you get the finances from financial intermediary, it's a financial intermediary's money, right? So you are responsible to manage it, but anything happens, you can leave out the organization. Who is responsible is the board of directors, if not the owners, shareholders, major shareholders. Their money is at risk. So that's the moral hazard. When you see a safety net, people tend to take risk beyond what they should be taking. Like insurance, that when you have insurance, you are recklessly drive. You have full insurance, yes. So if you have third-party insurance, you are a little mindful. So these are things, I mean, if you have been given an office or company maintained vehicle, you're a little careless. So if it is your own vehicle, you probably be a little more mindful, right? This is indirectly also push depositors not imposing market discipline. So when there's a safety net, depositors, now you are a depositor of banking, you are not worried whether this bank is doing the right thing, because you know my deposit insurance, if anything happens to this bank, I have the deposit insurance. So you are little not worried. Okay, so when you have a medical insurance or medical schemes by your organization, you are not worried, okay, if anything happens, I can have the medical insurance. But if you don't have, you will be really worried. You would not take, and you will mindful of your food habits and things like that. So similarly, when you see these safety nets available, even depositors would not bring in the market discipline. So if the market discipline is there, if your bank, if your financial intermediary is not doing the right thing, you would start taking the money out. So the bank is worried. If you try to do that and you are mindful of that, the bank is trying to manage themselves properly, because if not, people will start taking their deposits out. Okay, so as a result of so-called safety nets, financial intermediaries or the institutions have an incentive to take on greater risk. So they try to take beyond what is permissible. Then you see, similar to moral hazard, because of a government safety net, adverse selection also occurs. So the moral hazard is after the transaction usually, but adverse selection, okay, occurs when buyers have better information than sellers, and so the highest cost consumers end up buying a particular product. So buyers know better information than sellers. So in this case, the borrowers, sellers is the bank who try to kind of, part a financial facility. So the bank think every buyer who is coming to buy are riskier ones. So bank define its cost structures by looking at that all of the people who are coming to borrow from them are weak. And then the price of the so-called lending by these is high, so that itself discourage good borrowers to borrow. That's why now in banking you probably see different lending rates. You have a prime lending rate, you have general lending rate, you have junk or low credit quality people's lending rate. So there are various things because of these possibilities. But this adverse selection that happens. So then risk lovers who takes more risk find banking attractive, because they still think, yes, because banks wanted to balance good buyers, good customers and risky customers across the spectrum. So they balance the cost structure. So risky borrowers actually paying less than what actually they should be paying for the risk that they would be taking after having a financial facility. So for them, banking is attractive. Okay. So from another perspective, as already mentioned, depositors, they don't bring in market discipline. Also, they are little reason to monitor the financial institutions, because they think it is the business of the board of directors or the management. And some extent, they might not have the expertise to look at these things also. So you just go and deposit because of the established name and the established record of the financial intermediation. Once you start kind of getting into that mode, you lose the desire to follow how best these institutions been managed, right? And that is very important. That comes with so-called financial literacy, financial acumen, and when you know the different financial asset classes available for you to invest. So then you will look at, okay, if this is not managed properly, you will try to bring in discipline. So you see these safety nets that create moral hazard possibilities, that creates adverse selection. Okay. So another aspect of so-called safety nets. So you see the bank failures, bank runs, that's possible. So governments introduce safety nets. But at the same time, there's a concept called too big to fail. These institutions looks much wider and a big influence across the entirety of the economy. So very big. I mean, they share about a very big share of the financial market itself. When it is that big, right, the failure of institution of that nature would have substantive negative repercussion to the government and also to the general public. So the government kind of takes some responsibility in providing some assurance to the market in the form of guarantees, okay, of repayment to large uninsured creditors, okay, because these institutions are that big. So even without introducing deposit insurance schemes, sometimes the government introduces guarantees. So they guarantee the so-called uninsured creditors, that means the depositors in the banking institutions, okay, and thereby creating a false safety in the eyes of depositors or creditors for that matter. So the creditors get the government guarantee, knowing that if anything happens to this agency, government will honor. Okay, but effectively these agencies should not get government guarantee. They should manage on their own and make sure they honor their repayment obligations, right? So when they have this too big to fail tag behind their back, so they take that as a comfort, and that itself kind of push them not to manage their agencies properly. Okay, so this too big to fail again uses so-called purchase and assumption methods I was discussing in the previous section, right? So when it comes to these difficult circumstances, so they can use so-called purchase and assumption method by reorganizing the financial intermediary. Okay, so they reorganize, like when there is difficulty, they don't let these organizations to fail. They get other agencies to come and kind of shoulder them to stand strong, right? So we had experiences in Sri Lanka also to some extent at one time with respect to one financial intermediary, by bringing in other big financial intermediary to come and prop them up, right? So it's reorganizing, but it is like challenging, right? So these are kind of a cushions these financial intermediaries sometimes taken for granted. They think that because they are too big, government would not let them fail. So as a result, they become easy on their management. They ignore their responsibilities. Okay, so this the kind of reason to say that this too big to fail, yes, in a way that's kind of, you know, play a big role across different economic sectors, but providing a government safety net would increases the moral hazard incentives for these big banks. They think that somehow government would come and prevent us from failing, right? So this is challenging. Any questions? Right. So you see these possibilities, right? So to some extent, this the so-called safety nets government provided it comes also in the form of so-called financial consolidation. Now in Sri Lanka also there are arguments that there are too much small finance companies, leasing companies, so you should get big leasing companies, finance companies to amalgamate with small timers. That is with a good intention, right? But when it comes to too big institutions kind of emerge or consolidate, that makes that institutions to become much more bigger. Okay. Through consolidation, large and more complex financial organizations being established, and these financial intermediaries sometimes are much stronger and sometimes challenge the regulations too. Because sometimes you see global banking giants, they are much more bigger and stronger than smaller developing economies, countries' economies size itself. For instance, Sri Lanka's economy is about $90 billion US dollars. But some big global banks are $1 trillion in size. Very big. Okay, so so-called consolidation has good intentions, good purposes, but at times that creates financial intermediaries to become very big and challenge even the regulations. And this also magnified the so-called too big to fail problem. You know, too big to fail problem already. Okay, you are giving guarantees, and as a result, these institutions take them to kind of, you know, not manage their institutions properly. But with the consolidation and all, this problem would further magnify. Okay, so with the consolidation, the safety net also extend to new activities and increase incentives for risk-taking in these areas. And this is also one experience from global financial crisis that we discussed in our last lecture, right? So because these agencies are increasingly becoming big and large and also providing so-called safety nets in the form of FDICs, these agencies are expanding their risk-taking in the form of CDOs and other financial product innovations. And ultimately, that has led to the greatest financial crisis in 2008 that world has experienced. And then nobody knows where the underlying assets are. Right. So to see to some extent, of those possibilities that we now discussed in our previous slides, the regulations bring in various forms of introductions. So one possibility is they bring in restrictions on asset holdings. Okay, they bring in certain kind of descriptions to say that you can't hold assets beyond this much. Or in this sector, you can't hold this much of assets, right? So this restrictions attempts to bring in orderliness into financial intermediaries from too much risk-taking. So they bring in some discipline to avoid these financial intermediaries getting too much risk, because sometimes you see financial intermediaries might not necessarily look at the general economic activities, only would try to concentrate on areas where they have a large profitability, right? So they might try to lend into areas where, for instance, you can take it like condominiums, right? Real estate business. As long as you have experience in US experience, the prices are continuously rising. That is a wonderful area where you can blindly lend and get the return. But if you simply see a risk of pooling all your lending into that particular asset class, anything happens to the real estate or condominium market, the entire financial intermediary collapses. Similarly, right, bank regulations have been brought in. Let's say agriculture. You are lending only to the agricultural sector. So agriculture is doing fine, you are surviving. So if the agriculture exposed to, let's say, floods, or from another perspective, drought, it's common in Sri Lanka. Natural disasters. So the agriculture sector collapses. So the entire financial intermediaries, because they are exposed too much to that particular asset class, they collapse. So there are restrictions, bank regulations bring in to restrict your holding in one type of asset classes. Lending not beyond 1/5 to that particular sector. They introduce. So this is to provide or promote so-called diversification. So this is to say that you should not put all your eggs in one basket. You put your eggs in different baskets. So if you put all your eggs in one basket, if anything happens to that basket, all the eggs will break. So if you have different baskets, of course, one egg will break, other eggs will kind of survive. So they will hatch. Okay. So similarly, regulations are introduced to prohibit holding of common stocks. I mean, you see banks would have limits of holdings by individuals, or for that matter, single entity, single ownership limits. Okay, so banks normally have single ownership limits, because you see, if you let banks to hold by full, like entirety of the banks by one individual, it's like he would, and that institution would drive the entirety of that banking's operation. So they can drive these banks to the whims and fancies of that without looking at a general perspective in which the financial intermediation has been brought in. So this is also one problem we are facing now with some leasing companies in Sri Lanka. Finance and leasing companies in Sri Lanka. They probably be kind of, affiliated to one family, then they have problems. So you see the limitations, these regulations have been brought in terms of to promote diversification and also prohibit holdings of one type assets in the form of common stocks. Then there's kind of, bringing capital requirements. Okay, you can hold some kind of asset classes, but then for that you have to bring in additional capital. So they are mindful. They do not necessarily spend all their investments through deposits or borrowings, but ownership money also brought in. So they are then, it's a risky to the owners to get into that asset class. They think, oh, I have to bring in additional money if I'm investing beyond this level to this particular asset class. So naturally, they bring in some control into the equation. So these capital requirements come in the form of leverage ratios. What leverage ratio is? It means to evaluate a company's debt levels. Okay, so it's like how much of debt you own as a share of equity, or what is the debt to equity ratio, 12 to 1, 10 to 1. 10 times of debt to 1, or 5 times of debt to 5 to 1, 5 times of debt to 1. Depends on. If you have more debt, that means you are exposing too much into the risky areas. So there are elements of this into the equation. So then there's this Basel Accord. So there's a place called Basel in Switzerland. So that's where the financial regulators often meet and brainstorm different regulatory measures. So they bring in different regulation based on different country experiences and possible financial market risks. And they introduce different risk mitigation measures. So one kind of, recent introductions across different banking and financial intermediation is the risk-based capital requirements, risk-based capital adequacy ratios. So you can get into a risky asset class, but then you have to increase your capital to have such assets in your portfolio. Then they are mindful, as I was mentioning, owners have to bring in new money. They are mindful. Okay, so they don't expose the depositors into those asset investments, right? So these are codes, Basel and things like that. They bring in these disciplines into the equation. Similarly, regulatory arbitrage. Okay, so these capital requirements also bring in some elements where possibilities that the financial intermediaries try to play out loopholes in regulatory systems. It's like tax avoidance. You wanted to have a tax to have revenue being enhanced, but if you have given some options where the consumers can move out from that tax possibility, consumers would try to do that. So banks and financial intermediaries also look at this regulatory arbitrage, where they try to capitalize on loopholes in regulatory system, okay, in order to circumvent regulation. Regulator also knows, but probability that they would bring in such actions being covered through additional capital requirements to make sure that the banks are taking reasonable risk instead of exposing them too much. So these were financial institutions kind of measures that they are looking at to prevent these financial intermediaries taking too much risk. Okay, so you see these possibilities across different financial intermediaries. So I believe we have now come to kind of a very good point for us to elaborate a little more on these capital requirements, right? Any questions up to now in what we have discussed? Because I just want to highlight one element that we would not have our class next week, right? So the next week we will not meet at this time. Maybe they might arrange a different class, my time permitting. If not, we will see how best we can fit things in. And the following week, also I think it's 8th, and I hope the election will be over by that time, and we would be able to have the usual class as scheduled. Yeah, but this is a good point for me to kind of start capital requirements at next discussion. So if you have any questions, you can highlight it and we can discuss on that for the remaining few minutes for us to kind of elaborate on this. it seems that not much questions on this, but you see this capital requirement when we see it. Okay, so that's a kind of capital requirement which are government imposed capital requirements, right? So which sets like minimum capital stock for financial intermediaries, that you should have 5 billion, minimum 5 billion to start a financial intermediary. Oh, it's 10 billion. So it's a kind of a minimum capital that the government imposes these agencies to bring in. So that's one way of looking at it. Okay, so this can be elaborated differently with different forms of discussions. So I will take up that, because that would be easy for me to kind of, remind you all again some of these concepts when we meet next time. So if you don't have questions, we can stop at this point, and we will meet not next week, the following week. Okay, so with that note, I think we can close our discussions today. Thank you.